Well, Jerome Powell just us again. I'm Stephen Clark. I've flipped over 100 houses and I have sold over 200 houses. I'm going to tell you what this new news about the Federal Reserve rate hike means for you and me and the overall housing market as I see it. So if you type in housing or click on the news right now, you will see that all the news stories are about the Federal Reserve Board raising interest rates again. Everyone kind of suspected this would happen because about a week and a half ago, we got our consumer price index and it came in hot, they said, which means it came in at 8.3% inflation as opposed to 8.1%. So the stock market immediately sold off, losing over 800 points, and the cryptocurrency market was down, real estate market down. I mean, you can't really calculate the exact pricing, but we've seen that continue to trend down from the anticipation of what was just announced. It is now pretty certain that Wednesday, the Federal Reserve will raise interest rates again. They said 3 months ago when they raised it 3/4 of a percentage point, they said that this is a huge jump. They said that this is a big rate increase, and they will probably not do it again for a very long time, if ever.
No, God! No, God, please, no! No!
3 months later, here we are again doing this over and over and over. Jerome Powell said, and I quote, "I do not expect moves of this size to be common." Once again, 3 months later, he's doing the exact same thing. Even more dire, long-term historic trends that has shown a very clear correlation between interest rate spikes and coming recessions. So interest rates spike and then a recession happens. Now, the fact that the Fed is poised to do the same thing for the third consecutive time raising interest rates means that the recession that we're likely going into will just get deeper and worse. It is to the point that even the vice chair of the Federal Reserve said in a statement that at some point in the tightening cycle, the risk will become two-sided, which basically means it's going to do more harm than good for the overall economy. Couple that into the fact that there is widespread science and correlation again, and historic trends that the Fed overshoots inflation. So the big critique and criticism here is that Jerome Powell's not waiting long enough to see these interest rates take play and see the change of interest rates take hold. If you have an interest rate hike like we just did 3 months ago, we do not get those full effects of what it means for the interest rates hike as of yet. So the fact that they're going to jack it up again means that we won't feel this effect till either the late end of this year and or all the way into 2023. Now, this brings us to a really interesting point. And one of the things that people ask a lot on TikTok. If you go over there on TikTok, I do these quick little minute to 3 minute videos explaining the economy and the housing market and what the Federal Reserve is doing, and it's getting 60,000 views or whatever. And all the questions are, do I buy or sell? Let me show you something. This is my friend Erica, who's a realtor, talking about what she's seeing in the housing market right now. She has a listing for sale. It's a great listing. 6 months ago, it would be exactly at the price point where it would go in 24 hours. But this is what she said today.
If we get some money back, it's not going to be a problem. And I'm trying to talk him into just selling it cheaper anyway because he keeps holding out. Like, he's stuck on this 500,000 number, and then he's like, well, I will take 485 lowest. And I'm like, I don't think you're gonna get it. Like, I was talking to him yesterday, and I'm like, there's just no point of just sitting on this. The Feds are about to hike again, like 100 basis points this time. They've never done that, ever. So I'm like, you don't want to just sit around and wait until you price more people out, and I don't think you're going to get it anyway. And like, the smartest thing to do is just sell it and move on. So.
And this is not atypical. A lot of people, including myself with the houses I'm trying to exit right now, have seen the same thing. normal price points that 6 months ago would fly off the shelves with multiple offers and several showings are not moving. What's even more concerning to me personally is the fact that this is not the luxury market that's necessarily being affected. Of course, in that example just now, you heard that they're around the $500,000 price point, but for their market, it is a first-time home buyer's price point. For my market that I work in, the $250,000 to $350,000 is a first-time home buyer price point. Now, if you look back at the 2008 recession, you can see that the luxury price points got hit first and got hit the hardest. And then it trickled down to the rest of the markets, whereas a lot of that first-time home buyer market was able to shake off and not experience the worst of the recession in 2008. What's concerning about this one, to me personally, is that this is where the worst of it is being felt not only in the luxury market but also in the first-time home buying market. Those things are supposed to be insulated from the broader market conditions, especially in the housing crash. It should be the last thing that crashes. But since it's an interest rate driven Federal Reserve hike recession coming on, then it's hitting affordability. And that's a problem. So what can people expect to see? What are 3 things people can expect to see? Number 1, the home price correction is spreading. The 98 major regional housing markets where home prices are already falling are spreading more and more and more. California being hit some of the hardest, the West Coast being hit some of the hardest, but some of those really, really good markets of the middle of the country and the Southeast, where I am, where I invest, is also being hit, and it's spreading to other B+ markets and C+ markets. Obviously, the mortgage rates has gone up from 3% to 6.3% already this year, and it looks like it is going more and more and more. That's more than a 200% difference. And I had to look up that math, and I know that's right because I thought it was a 300% difference because I thought it was 3 times, but it's not. It's 3 times, but it's a 200% difference. Little fun fact. Number 2, what will we see? The housing downturn will soon spread beyond housing. Now, this is the big fear, and this is something that I get on TikTok, saying that it's not that big a deal because we still have really great unemployment, which means unemployment is low, and we don't have massive job loss. And what they mean and what they're saying is that when you are looking at a housing market, the best way to judge a housing market is by the unemployment rate. So if we have low unemployments in the nation, then we'd have a good housing market. But that is true for right now, but I don't think it will hold much longer, and neither do the analysts. The year-over-year change in private residential fixed investments, the GDP, i.e. the housing income. So we can see that the Goldman Sachs forecast for 2022 and 2023 is negative. And firms like Redfin Realtor and Compass have already issued layoffs. So have home builders, so have mortgage companies. They are already gearing up for this, and they're already laying it off. Recessions usually last about 11 to 12 months, which doesn't seem like a long time, but that can be a trek when you are jobless or looking for a house or trying to make your mortgage payments and trying to keep them afloat. And the third thing we're seeing is sellers are calling time out. Now, that's another thing that people talk about on TikTok a lot, about supply and demand. They say we don't talk about supply and demand enough because there is still a supply of a ton of houses that will come on, and there is still struggling to have enough houses for everybody, right? So they say that not only do we gonna have more homes that will come on the market, so it's gonna be okay, but we also have low supply right now and not an overabundance of supply. But that's once again as to be expected because these are brand new things. This has only been happening for a couple months. It takes a longer time, like we said at the top of the show, to really get to feel the entire effects of a change in the housing market downturn. But once again, this is how bad it is now. While we're anticipating a new Federal Reserve rate hike, there's still potential more to come. They might do this more, they might do this again. We will look more into these videos. Thank you for watching. I think that we'll do a video about is now the right time to buy or sell and delve more into that because that's what people want to know. But for right now, for what I am doing, I am cashing out of my investments that are flips, holding on to my Airbnbs and long-term rentals right now because the income is better than the outgoing, which means the income is more than the mortgage payments, which is great. Significantly more, which is what you need for it to break even. And I am freezing buying new flip properties, and I'm trying to slash the prices of my flips as much as possible to get them gone. If I were to buy a permanent residence, which I may, again, like a new permanent residence, I would probably start to look in the February, March, April months of 2023, just based off of a little bit of guesstimation from what we're seeing right now. Of course, all that's going to change, I'm sure, but for right now, that's my current timeline. Let me know what you think.